So maybe we'll look at this one, 23-26A. Kind of give you a taste of what this is about. So it's a flexible versus static budget situation. So let's see, cellular technologies manufactures capacitors for cellular base stations and other communications applications. Okay. The company's July 2014 flexible budget shows output levels of 7,500, 9,000, and 11,000. So what they do is they make these budgets that are based on generating different levels of units. Okay. And then a static budget, right? It says the static budget was based on expected sales of 9,000 units. So a static budget is more fixed. It's fixed at a certain level of units. Okay, so let's pull up this flexible budget. And they show us this flexible budget here based on 7,500, 9,000, and 11,000 units. And then they give the per unit amounts for the pertinent, for the variable items, right? So the variable items would be the revenue and the variable expenses. Price being 25 and variable expenses per unit at 13. So what's really happening in here is to get this revenue figure, they're multiplying 7,500 units by $25. That gives you 187,500. Same thing here. To get the $225,000 in the 9,000 unit column, you're going to take the price of 25 times 9,000 units. Okay, and that would be the same for the variable expenses. You take the number of units for each column and multiply it by the variable cost of $13 per unit. Okay. So let's see. That's the flexible. And then it says the company sold 11,000 units during July, and its actual operating income was as follows. So they have an income statement. Maybe we can squeeze these things in there. Okay, so here's the actuals. So you got actual sales units of 11,000. So I'm going to plug that into my actual column. 11,000 units. Alright. And then the budgeted amounts per unit are listed here. So $25 and 13 variable expenses. Okay. And let's see, they mentioned it up here. The static budget was based on expected sales of 9,000 units. So out here on the far right, you have your static budget of 9,000 units. Okay.
Where did you get the 11,000 from?
The 11,000 is here. The company sold 11,000 units during July. So that's what actually happened. So I'll put it in the actual column. Okay. Then what we need to do is we need to populate this with the information that we have available. We'll start populating our performance report, right? What we're going to do is we're going to be comparing actual results to both the flexible budget and the static budget. Now the flexible budget is going to be based on actual units, okay? But it's going to be cast out at budgeted amounts. Okay. So we're going to have to multiply. Basically, we're going to take what's in this column. Okay. That's what the flexible budget will be based on. 11,000 units, which is actual, times the budgeted amounts. So I can drop those figures in. 275, 143. That difference between the two is your contribution margin of 132. And then you got fixed cost of 54. And the difference between, okay, so that's the flexible budget. Now the static budget is based on the 9,000 units. So we can pull this column here, because that's budgeted unit amounts, right, times the static number of units. So we'll pull that column in here. Now we gotta do a little bit of math, right? We gotta take our actuals, right? So this is our actual results. Drop them in here. Make sure you put them in correctly. Okay. Now what we're gonna do is, see column 2 and 4, they tell you what math to use, right? When we do our comparison. So it's saying to get the numbers in column 2, you're gonna take column 1 and subtract column 3 from column 1. So if you got your calculator available, it might make it easier. We'll take 282 in revenue minus 275. Okay, so we're taking the actual revenue and subtracting the
Flexible.
yeah. So we got $7,000. So what this says is our actual results are $7,000 more than what we have in the flexible budget. Okay, so up here it's telling you, if I scroll back up, right, in green, you need to tag them, right? So right, you're gonna label them either favorable or unfavorable. So since revenue was more than the budget, that's considered favorable. We'll give it an F. So this is one case where a F is good. Okay. Now we'll go down. We're gonna take our actual variable expenses, okay, and subtract our flexible budget variable expenses. 148,200 minus 143. Now that's 5,200. Now I don't think we need to show it as negative. A lot of times if it's unfavorable, we would show it as negative. For this problem, it doesn't appear that they're asking for that, but we'll try it this way. See, because the expenses, right? Because the actual variable expenses of 148,200 are more than what the budget is. That's unfavorable because you got more expense than you projected. Okay, so you got to be careful in that. Now, a lot of times we would show that 5,200 as negative, but in this case, we'll leave it like that. Okay. So your contribution margin, that's a number that,
You want it to be high.
yes, you want it to be higher than the budget. Okay, so that's, since it is higher than the budget, the difference is 1,800. It's a favorable variance. Okay. And then expenses again, fixed expenses. The difference between the actual and the flexible budget, 1,500, but because it's more than the budget, it's unfavorable. Okay. And then right down here, we don't even need a calculator. $300 more in net income. That means it's favorable. Okay. So the template kind of shows you how to go through it because they give you the math up here at the top. Okay, now when we do column 4, the idea now is that we're treating the static budget column as the budget, and we're treating the flexible budget column, I don't want to say as the actuals, but as a comparing figure, right? So we're going to be judging the difference there. When they call these differences, column 2 and column 4, those differences are called variances. Okay, so we're going to take 275 and subtract the static budget amount of 225. So that's a $50,000 favorable. But variable expenses of 143 minus 117 actually are more, so that's a $26,000 unfavorable. Okay. So far so good, yeah?
Yep.
So we'll do it all the way down. this one is 0. And it says, up here in green it says, for variances, for any 0 variances, leave the favorable or unfavorable input blank. So we'll just leave that blank. Okay. And it looks like we have a favorable operating income $24,000. So we're hoping we carried the numbers over correctly and we did the math correctly. And it looks like we have a good job. Okay. Now they have labels. This is the old three-prong analysis format. So we're going to label actual versus flexible, and then we're going to label flexible versus static. Okay, and then we're going to talk about the overall variance. So let's see what our options all are. Okay. Well, I'm going to call this the flexible budget variance, because it's the actual versus the flexible. And then we're going to call this one over here the sales volume variance, because this one is based basically on the difference in sales volume. Right? That's what's driving the difference, right, between these two. And then the overall one will be called the static budget variance, because that's comparing actual to the static. And with that one, we're going to have to do a little bit of math. But for the two inside ones here, we just pulled a number down. We got 300 favorable, and we got 24,000 favorable. Okay. And then if you were to do the math, if you were to take 78,300 and subtract 54,000 way out here on the right, your difference would be the equivalent of compiling the 300 and the 24,000, because these two make up the overall variance. So you just have to be careful, because sometimes you'll have an unfavorable flexible and a favorable. In that case, you'd have to subtract. You'd have to get the difference. Yeah. But in this case, they're both favorable, so I can just add 24,000 to 300. What? 24,300. And it's going to be favorable. Okay. Does that make sense?
Yeah, so
Yeah.
if there's a favorable and an unfavorable, you just have to subtract it.
Yeah. And sometimes the unfavorable amount will be more than the favorable amount, so your overall variance will be unfavorable. It'll be the net between the two. Okay?
Yeah.
Let's see. What was the effect on Cellular's operating income of selling 2,000 more units, or selling 2,000 units more than the static budget level of sales? So on the operating income, the effect was this 24,000. That's where the sales volume is coming into play. Sales volume variance. So we'll say selling 2,000 units more than the static budget level of sales increased Cellular's operating income by 24,000. I think I like that, right? Because that's isolating the effect of an increased sales volume, the difference between column 3 and 5. And we're taking the operating income figure, because that's what they're asking about. So let's see. Okay? You see how that worked? So it's basically making you think about it in words versus just a visual of the numbers. Okay. Then it says, what is Cellular's static budget variance? So we got that from our figure here. It's the overall amount of 24,300, and that's favorable. And that means that Cellular's operating income is higher than expected for the static budget. Okay? So So this thing is being called the net income flexible budget performance report. And now they want me to explain why the income statement performance report provides more useful information to Cellular's managers than a simple static budget variance. Okay, so what they're saying is, why does this provide more useful information, yeah, than just comparing actuals to static? That's what they mean, right? Because you could very easily compare the actual results to the static budget. And then what insights can Cellular's managers draw from this performance report? Choose 2 reasons why the income statement performance report provides Cellular's managers with more information than a simple static budget variance. So let's see what they offer us. Let's see the first one. A favorable sales revenue flexible budget variance means the sales price was higher than planned. That's a possibility. Let's come back up. Favorable sales revenue flexible budget. Okay, so that would be true because when we do the comparison in the flexible budget variance category, we're not changing the volume. See, the volume stays the same, the number of units sold. So really, this total sales revenue difference, right, is going to be driven by a higher actual price. Okay, so I like that one. Okay, let's see. A favorable sales volume variance reveals whether profits increase due to fewer units being sold. Well, if you're going to be looking at volume, and if it's going to be favorable, then if you're isolating volume, then that means more units were sold than you expected. Okay, so that's saying fewer. I think the third one, a favorable sales volume variance reveals whether profits increase due to more units being sold. That's a good one. Let's just rule out the fourth one, right? An unfavorable sales revenue flexible budget variance means the sales price was higher than planned. No, that's contradicting that first one we chose. So I'm going to go with 1 and 3 here. Okay. All right. Let's see. These variances suggest that the marketing department did a good job because they sold more than they expected to. They sold 2,000 more, right? They sold more units than expected and sold them at a higher price. They sold them for more than $25. If you wanted to know how much they sold them for per unit on average, we could easily come back over here and take the actual sales revenue of 282,000 and divide by the number of units sold, 11,000. Right? They sold it for roughly 64 cents more, right? If you round. Then, right, so instead of selling it for the budgeted price of $25, they sold it for $25.63, rounded to $25.64. Okay. So we can come down here and hit check answer, and it's a job well done. Any questions on that one?
No, I think that's alright.
Okay, that's a good one to master.